if your return on equity as a cash flow position hasn't outstripped inflation, you're kind of just in the same position as you were. So that's why we like the analysis of return on the equity that's stuck in the deal, because it quantifies, shall I sell this, realize the equity and invest in other things? So it gives you that metric which you can then go and hunt for better returns.
Why the metric of return on equity is so important for opportunity cost.
Interestingly, when people are in property investment, property development, HMOs, anything else, they tend to look at return on investment. They tend to look at yield, gross yield, net yield. They tend to look at profit on GDV. They tend to look at IRR, which is indefinite rate of return, or we call it annualized rate of return. So it's always return on cash. And essentially, one metric that always gets missed is the end of the project in our HMO portfolio, for an example. So this is actually our cluster flat block of HMOs. It nets just over $3,000 net, which is 71% return on cash left in, which is great. Really happy with that. That cash that's stuck in that deal that could be pulled out and put into other stuff is accruing a 71% return. So really happy with that. Cool, great, fantastic, thank you. What we can't ignore though is the gross development value of this site is £1.3 million, which means the total equity, so the equity is the profit plus the cash left in, is 391,000. So that could be money that we could have back into our business, our wheelhouse, investing in other things. And we want to make sure that we're quantifying the cost of that capital staying in there, because that's a huge opportunity cost, especially if you're a young growing business. That needs to be a good return. What I mean by needs to be a good return is essentially outstripping inflation, because what will happen is 5 years will come around to refinance, or 10 years will come to round refinance or sell or exit. And if your return on equity as a cash flow position hasn't outstripped inflation, you're kind of just in the same position as you were. So that's why we like the analysis of return on the equity that's stuck in the deal, because it quantifies, shall I sell this, realize the equity and invest in other things. So it gives you that metric which you can then go and hunt for better returns. This particular project, the reason there's 3 columns is because it's a mortgage stress test, 3 different values, and essentially we should get a mortgage lower than 5.5% on this particular site. So I think it's actually 5.04, which is really good. The current return on equity is showing is 9.77%. So that's every year the cash flow produces a 10% return on the cash equity that's left in that would have been realized if we sold it. Yes, there's some sales fees and things like that, but that metric is really important, because if we know that we can get better than that in the market, we then know we're probably better off trading that site on to materialize a decision whether to hold or sell. And we've got sites where that return on equity is like 3%. We're locked in on a 5-year fix. Let that spreadsheet communicate with you and tell you how aggressively that's producing a return on your own cash, because that cash could come out and go into other things. So it's just not to ignore return on equity, basically.
If you got a value from this video, make sure you click the subscribe button down below and ring the notification bell, because we release one video at least every week, so you'll be the first to get notified. See you on the next one.